Ladies and gentlemen, stop for a moment and really look at your screen. Those red numbers flashing back at you are not just prices. They are pressure. They are designed to trigger fear, doubt, and urgency all at once. I know exactly what you're feeling right now. The tightness in your chest, the voice in your head asking whether you made a mistake. Whether this was the moment you should get out before things get worse. Just 48 hours ago, silver was brushing against record highs. The mood was euphoric. Triple-digit prices were no longer a fantasy but a conversation. Now it's Monday morning, December 29th, and silver is sitting at $75. The chart looks ugly. Momentum looks broken. And the mainstream narrative is already forming. The bubble has burst. The squeeze is over. Sell before it collapses. Stop, breathe, listen carefully. Nothing real has changed. No new supply appeared over the weekend. No mine discovered a hidden mountain of silver. No policy was reversed. The physical world is exactly the same as it was 2 days ago. The only thing that changed is the number on your screen. What you're witnessing is not a collapse, it's a setup. The final week of the year is not a normal market. Liquidity dries up, volume thins out. Senior decision makers are gone. What remains is an empty arena run by algorithms and junior desks reacting to low-volume noise. In this environment, prices don't move because fundamentals shift. They move because there's no resistance. A single push can look like a breakdown. A temporary air pocket can feel like the end of the story, and that illusion exists for one reason only: to test your conviction. This is where markets transfer wealth, not through intelligence, but through emotion. If you mistake illusion for reality, you hand over your position to someone who understands the difference. This week has a name, and understanding it may change how you see everything that follows. Type 1. To continue, 2. Chapter 2. Type 2 to stop here. If this already changed how you're reading the chart, subscribe to the channel and comment 1 below. Now that you've taken a breath, let's talk about why this moment feels so violent, and why it was almost guaranteed to happen right now. Markets don't just move on numbers, they move on structure. And the structure of this particular week is fundamentally broken. The days between Christmas and New Year's are what professionals quietly refer to as a dead zone. Volume collapses, order books thin out, liquidity evaporates. In a normal week, if someone wants to sell a large block of silver, there are layers of buyers waiting. The transaction gets absorbed. The price barely flinches. It's like tossing a stone into the ocean. But this week isn't the ocean, it's a bathtub. When liquidity disappears, the market becomes fragile. One aggressive sell order doesn't meet resistance, it falls through empty space. Prices don't decline gradually, they drop vertically until they collide with the next technical level, where someone somewhere is willing to step in. That sudden fall looks terrifying on a chart, but it's not a reflection of value. It's a reflection of absence. And this is where psychology enters the equation. A sharp red candle doesn't just move price. It sends a signal. Technical systems read it as failure. Momentum traders read it as weakness. Retail investors read it as danger. The market doesn't need bad news when it can manufacture fear through optics alone. Ask yourself a simple question: if silver's fundamentals were truly broken, if the long-term thesis had collapsed, why would this move happen during the lowest volume week of the entire year? Why not during peak participation when conviction could be tested honestly? Because this isn't about discovery, it's about exploitation. Thin markets allow small actions to create exaggerated reactions, and exaggerated reactions force emotional decisions. This is not random volatility, it's predictable behavior in a distorted environment. And the chart isn't lying, but it's not telling the whole truth either. You're watching shadows move on the wall, not the source of the light. And if you don't understand the structure behind the movement, you'll misinterpret noise as signal. Before you react, before you decide anything, you need to understand who benefits from this confusion and who doesn't. To understand what's really happening, you have to stop thinking like a chart reader and start thinking like a poker player. This move to $75 isn't about silver, it's about you. More specifically, it's about your emotions, your leverage, and your pain threshold. Large institutions know exactly how retail positioning works. They know where late buyers entered 78.79 near the highs. They know how many traders are sitting on margin, they know how many options expire this week, and most importantly, they know where the stop-loss orders are clustered. Those levels aren't a mystery. They're visible footprints. In a thin market, triggering those stops costs almost nothing. A brief, aggressive push downward is enough to trip a chain reaction. Once the price hits those levels, selling becomes automatic. Computers sell, brokers liquidate, traders panic, and suddenly a manufactured drop feeds on itself. Here's the part most people miss. The selling you're seeing isn't voluntary, it's forced. It's margin calls, it's stop-loss executions, it's fear doing exactly what it was designed to do. And on the other side of every forced sale is a buyer who wanted your position all along. This is called a liquidity flush. Shake the tree, see what falls out. Weak hands let go, not because they're wrong, but because they're uncomfortable, and discomfort is expensive in markets. Ask yourself, who would benefit from silver being cheaper right now? Who would want to accumulate before a known structural change? It's not the small trader staring at a phone screen. It's the entities with time, capital, and patience. This is why these moves always feel personal. They're meant to. Doubt creeps in quietly. Maybe the thesis is wrong. Maybe the shortage isn't real. Maybe I should just protect what's left. That internal conversation is the real battlefield. Markets don't punish ignorance. They punish emotional reactions, and moments like this are designed to separate those who react from those who observe. If you're still focused only on the New York chart, you're missing the most important signal in the entire market right now. Because while one side of the world is being shaken out, the other side is doing something very different. And that's where the story truly changes. While fear dominates one screen, discipline controls another. To see it, you have to stop staring at New York and look east. Because at the exact moment silver is being shaken out in the West, it's being pulled in with urgency in Asia. In China, silver isn't a speculative storyline, it's an industrial lifeline. It runs through solar production, electronics, and energy infrastructure. Buyers there don't care about a red candle on a holiday chart. They care about securing metal, keeping factories running, and protecting supply chains. And right now, they're willing to pay a premium to do it. This is where the narrative fractures. Western traders are reacting to a $75 paper quote, but Chinese markets are trading a different reality, one that signals tightness, not weakness. The gap between these two prices isn't a rounding error. It's wide, stubborn, and increasingly hard to explain away. In a functioning global market, that shouldn't happen. Arbitrage is supposed to erase differences fast. Buy cheap here, sell higher there, and the spread disappears. That mechanism is the glue that keeps global pricing honest. But today that glue is failing, and it's not because traders forgot the math. It's because something is blocking the flow. When arbitrage breaks, it's not a curiosity, it's a warning. It tells you the market that actually needs silver is valuing it far more than the market that merely trades it. One price reflects physical necessity, the other reflects thin liquidity derivatives and ghost-weak psychology. Two prices are forming for the same asset, one driven by fear, one driven by need. History is very clear about how this ends. When physical demand refuses to follow paper weakness, the paper price eventually snaps back to reality hard. One side is shaking out, the other is accumulating, and the distance between those two actions is where the real opportunity hides. Now we need to confront the number that exposes the entire illusion. Because once you do the math, the $75 price stops looking scary and starts looking absurd. While New York traders are staring at a falling chart, the Shanghai market is broadcasting a completely different signal. The front-month silver contract there is trading at a level that, once converted properly, implies a price close to $90 per ounce. Let that settle in. Nearly 90. This is not a rumor, it's not speculation, it's arithmetic. When you translate the Shanghai futures price into US dollars and then into troy ounces, the result is a premium of roughly $14 over the Western paper price. In global commodity markets, a spread of that magnitude is extraordinary. On a fungible metal, it borders on impossible. Under normal conditions, this gap would vanish almost instantly. Arbitrage desks would buy silver in New York at 75, ship it east, and sell it near 90. The profit would be risk-free. The spread would close within hours. The fact that it has not tells you something is deeply wrong or deeply revealing. The arbitrage mechanism is no longer functioning. And when arbitrage breaks, it's not because opportunity disappeared, it's because access did. Something is preventing metal and money from flowing freely between these two markets. That blockage is what's creating this distorted picture, and it's also what's creating opportunity for anyone who understands it. Ask yourself which price reflects reality, the one set by thin holiday trading and algorithms, or the one set by industrial buyers securing metal they actually need. Factories don't buy panic, they buy necessity. This spread isn't signaling the end of a rally, it's signaling stress. It's the market screaming that the paper price is detached from physical truth. And detachment like this doesn't resolve gently. It resolves violently. So why is not this $14 gap closed already? Why is there still silver priced at $75 in the West while the East is paying nearly $90? The answer is simple but uncomfortable. The bridge between these two markets is broken. For arbitrage to work, metal and capital must move freely in both directions. That freedom no longer exists. New export licensing rules are about to lock silver inside China, turning what was once a global flow into a one-way valve. You can move metal in, but getting it back out is another matter entirely. For a Western bank, this creates a nightmare scenario. Ship silver east to capture the higher price, and you risk being paid in local currency you can't easily convert or remove. Worse, if the trade goes wrong, you may never recover the metal. That uncertainty turns what looks like easy profit into unacceptable risk. So, the arbitrage desks freeze. When arbitrage freezes, prices are allowed to drift apart, and that's exactly what we're seeing. The Western market has effectively become an island. It's dominated by paper contracts, derivatives, and short-term speculation. Prices there respond to sentiment charts and low-volume games. Meanwhile, the Eastern market is anchored in physical demand factories, infrastructure, and long-term planning. This creates two realities. One price reflects fear and thin liquidity. The other reflects necessity and preparation. History shows how this ends. Paper markets don't dictate value forever. When physical demand tightens and supply can't respond, the paper price is forced to adjust, often suddenly and painfully. This divergence isn't weakness, it's pressure building beneath the surface. The wider the gap becomes, the more violent the eventual correction will be. And right now, that pressure is rising, not releasing. The question is no longer whether the prices reconnect. The question is how fast and at what level when they do. At this point, the price action stops being about markets and starts being about psychology. Because if the fundamentals are tightening, if the physical price is screaming higher, why smash silver down to 75 right now? Why do it during the quietest, thinnest week of the year? Because this is the moment fear is cheapest to manufacture. The days between Christmas and New Year's create a perfect psychological vacuum. Volume is low, attention is scattered. Retail traders are over-leveraged from chasing the recent highs. Stop-loss orders are stacked tightly below the market. In this environment, a relatively small push can trigger a disproportionate emotional response. That response is the real objective. Institutions aren't selling because they believe silver is worth less. They're selling because they want to buy more at your expense. By driving the price down during Ghost Week, they force liquidations. Margin calls fire. Stops get hit. Weak hands are shaken loose. And who buys what gets dumped? The same entities that caused the move. This is not a theory. It's a recurring pattern. Markets are most aggressive when participation is lowest because resistance is minimal. A move that would cost billions during normal volume can be executed for a fraction of the price in a holiday vacuum. This is why the drop feels personal. It attacks confidence, not logic. Doubt creeps in quietly. Maybe the thesis is wrong. Maybe I should just protect myself. That internal dialogue is the battlefield. But look at the timing. We are days away from a structural shift that tightens supply even further. Do you really believe the smartest capital in the world is panic selling days before that happens? Or are they using this window to accumulate while attention is elsewhere? This isn't a breakdown, it's a clearance event. The final shakeout before the rules change. Now we have to talk about the calendar because timing is the silent force behind everything you're seeing. This isn't some vague outlook for next year or a distant macro theory. This is a hard deadline measured in days, not months. January 1st changes the rules. New export licensing requirements turn silver from a freely traded commodity into a controlled strategic resource. Bureaucracy replaces flow. Permissions replace markets, and in systems like this, delays aren't measured in hours, they're measured in weeks, sometimes longer. For the month of January, effective supply out of China doesn't just slow down, it freezes. That's why buyers in Asia are acting now. They aren't reacting to price, they're reacting to access. Every factory manager, every procurement desk understands the same reality. Metal secured today is metal guaranteed. Metal not secured may not arrive at all. This is insurance pricing, not speculation. That urgency is what you're seeing embedded in the Eastern market. Meanwhile, the West is still playing holiday games, reacting to candles and indicators as if nothing structural is about to change. This disconnect won't survive contact with reality. On January 2nd, desks return, phones ring, inventory sheets get reviewed, and Western buyers discover that the supply they assumed was always available is now gated, delayed, or simply gone. That's when price discovery actually begins. The $75 quote exists only because demand is temporarily absent, not because value is. When real buyers re-enter, they won't negotiate with fear. They'll compete with urgency. And urgency doesn't ask for discounts. This drop isn't the start of something ending. It's the pause before something irreversible begins. The countdown is almost over and the market is about to wake up. When the market wakes up, it won't ease into awareness. It will lurch. Because the moment Western desks reopen, they will be forced to reconcile two prices that should never have been allowed to drift this far apart. One reflects paper fear. The other reflects physical urgency. And that reconciliation won't be polite. On January 2nd, institutional money comes back online. Portfolio rebalancing begins. Procurement managers re-enter. And the first thing they'll notice is the spread. Silver priced cheaply in the West, expensively in the East. In any rational system, that gap is intolerable. So buying accelerates. Not because of optimism, but because of necessity. If you're an industrial user and you see metal trading higher overseas while sitting artificially cheap at home, you don't hesitate. You secure supply. You stand for delivery. You drain the cheapest market first. That's how inventory disappears. As Western vaults thin, the paper price loses its anchor. Contracts that once settled quietly now face delivery pressure. And when delivery pressure meets limited supply, repricing isn't gradual, it's explosive. This is why trying to trade this environment is dangerous. Volatility won't respect logic. Swings will be violent. Algorithms will hunt both sides. Anyone attempting to outsmart the move risks being shaken out just as the real repricing begins. The irony is brutal. The dip everyone wanted arrives and the majority are too frightened to act. Meanwhile, the entities with patience and capital are doing nothing flashy at all. They're accumulating quietly, letting time do the work. This is how paper illusions end. Not with a slow fade, but with a sudden snap back to physical reality. And when that snap happens, the price won't wait for permission. It will gap. What feels uncomfortable now is exactly what opportunity has always felt like before it becomes obvious. This is where everything comes together and where experience matters more than excitement. After decades of watching markets rise, fall, break, and reinvent themselves, one lesson remains constant. The biggest gains are never handed to the loudest traders. They're given to the most disciplined ones. What you're witnessing now is not chaos. It's a transition, a shift from a paper-driven narrative to a physically constrained reality. The price drop to 75 was not a verdict on silver's future. It was a test of resolve before repricing. A final attempt to transfer conviction from the impatient to the prepared. The lesson here is simple but uncomfortable. Markets don't reward those who react fastest. They reward those who understand structure, timing, and psychology. When fear is highest and headlines are loudest, the most important work is internal, staying rational while others panic. The strategy in moments like this is rarely dramatic. It's patience. It's position, sizing that lets you sleep at night. It's refusing to let short-term volatility override long-term reality. You don't need to predict every tick. You need to survive the noise long enough to benefit from the signal. Silver's story isn't about a single week or a single price. It's about scarcity industrial demand and a global system struggling to reconcile paper promises with physical limits. Those forces don't resolve quietly. They resolve decisively. If there's one takeaway, it's this: never confuse volatility with risk. Volatility is visible. Risk is structural. And right now, the structural risk isn't owning silver. It's not understanding why the market is trying so hard to scare you out of it. Stay grounded, stay curious, stay disciplined. If this analysis helped you see the market more clearly, subscribe to the channel, like this video, and share it with someone who needs perspective right now. And comment 1 if you're focused on strategy, not panic. This is where long-term thinking begins.